Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. Before I begin, I'd like to say on behalf of all of us at Saracen how deeply saddened we are by the death of Queen Elizabeth II. We offer our sincere condolences to His Majesty the King and all of the royal family at this time of mourning, and respectfully give thanks for her life of dedicated service to her country. With only a week to go before a pivotal Federal Reserve meeting, a broadening of US inflation data has roiled markets once again. Core inflation rose from 6.1 to 6.3%, and what worried investors, it was mainly in stickier items like rents and shelter, education, medical care and restaurants. Bets on a 75 basis point rise now look a certainty, while some, like Larry Summers, the former Treasury Secretary, are arguing for a jumbo 100 basis points to ram the message home that the Federal Reserve is serious about taking inflation back to target. The switch in market expectations shows yet again how vulnerable markets are to stickier data and how robust central bankers still need to be. So don't fight the Fed, at least not yet. Yields can still go higher, equities lower, and the dollar stronger. We still remain underweight equities and bonds, overweight alternatives and cash. But yes, we admit to being tempted, especially in fixed interest, where sterling investment grade yields are now over 5.2%. Patience, though, for a while longer may yet be rewarded. So let's look at that troublesome US inflation print in a little bit more detail on the first slide. In the right-hand panel you can see the US CPI headline rate, that's the red line, rolling over, but that US CPI core rate, that's ex food and energy, the inflation rate beginning to climb again to 6.3%. Break that down in the left-hand panel to flexible items where prices typically move fast, food, energy, commodities, and that's rolled over quite nicely but still rising at 14%, a high number. What worried investors though was the blue line, the sticky items, rent, rates, service charges, etc., medical costs, which have started to climb quite sharply and shows inflation beginning to broaden out in the US economy. That potentially worries the Federal Reserve and argues for higher rates for longer. Our own forecasts broadly reflect this, and we see rates rising somewhere between 3.5% to 4% by early 2023. A little bit more dovish than the market, which sees rates over 4%, but still room for some large 75 basis point moves from here. Tighter money for longer, of course, is trouble for investment markets. It hurts all real assets, it drives bond yields higher, and it pushes the dollar to multi-year highs. And that, I'm afraid, is still what's happening in markets. You can see this in the left-hand panel, all major assets down, gold and world equities, UK bonds now down nearly 20%, the Nasdaq down 25%, and speculative assets like Bitcoin down by more than 50%. This is typical in a sharply tighter monetary policy environment. In addition, of course, the dollar is being forced higher to multi-year highs. This puts huge pressure on the emerging markets, hence, by the way, our low weighting there. And of course, we're seeing US 10-year bond yields rise. They are beginning to get to levels where we're potentially attracted, but we're not making the move yet. But there is hope. I don't want to be too gloomy in this outlook. Three things encourage me. First of all, if you look at the UK economy as an example, we don't expect a deep recession this time round. A mild, jobful recession is more likely. Why? On the left-hand panel, personal savings surged, as you can see, during lockdown in 2020-2021, and that gives consumers a very robust buffer. The Bank of England estimates £180 billion, or 13% of annual consumption, to offset the energy price shock. Secondly, it looks as though Liz Truss is going to cap energy prices at £2,500 going forward, and we see similar moves across other economies with just similar announcements from France this week. Thirdly, on the right-hand panel, the UK and global labour markets remain extraordinarily robust. UK unemployment at 3.8%, close to a 50-year low, and UK job vacancies, though they came off a little bit, are the highest we've seen in post-war history. So a strong labour market, which of course underpins consumption. So a mild, jobful recession, still our base case. The second reason why we're reasonably encouraged is that the Chinese slowdown, ironically, has come to our rescue. Why is this? Yes, the data is very weak, retail sales in particular just 2.7%, and that is putting a lot of pressure on Asian growth. But critically for the West, it means lower demand for commodities. It's allowing crude oil to fall, as you can see in the right-hand panel, to $88, down from about 126 at peak this year. And importantly, industrial and commodity prices as well. And you can see that sharp fall in the Economist Industrial Commodities Index. Thirdly and finally, despite the pressure on profits from rising producer prices and US and unit labour costs, as you can see on the left, US profits are not yet falling sharply. And we're certainly not hearing from the companies that come through our door great weakness in their underlying earnings or profits. Why is this, of course? Because the top line is being flattered by high inflation. Yes, growth is falling in real terms, but in nominal terms, with 10% inflation, growth is still very strong. That means the global sales growth, and I've used here the FactSet Macro Bonds index across world markets, still shows top line growth of 12%. Now that's being flattered a bit by oil, but you can see inflation lifting that top line growth helps a lot to secure corporate profits going forward from here. So how and what are our conclusions? Well, don't bet against the Fed yet. It's still too dangerous with a tempo of rising interest rates and uncertainty still over stickier inflation items as we saw earlier. So we're sticking to an underweight in bonds, sticking to an underweight in equities, but I must admit we're tempted to move, tempted I would add. Certainly in bond markets where UK investment grade paper, that's high quality corporates, is now yielding more than 5.2%. Instead we're still keeping our overweight in alternatives, particularly renewable energy and infrastructure, and we held a big buffer position in cash. So yes, we're ready to move. Yes, we're ready to move fast if, say, the dollar comes off and inflation numbers improve. But for the moment, don't fight the Fed, and patience for a while longer will probably be rewarded. Thank you.